Hi again, everybody. In this quick tutorial, we're going to look at how to calculate the present value of an interest factor of an annuity. All right, so we've got a formula here, and this is, well, first of all, again, an annuity is a fixed income or payment that's being received over in intervals of equal time periods, right? So we've got a situation here where an organization is expecting a net income of sales of 2,650,000 minus costs of $840,000. So in other words, their net income before tax is 1,810,000. They're expecting the same amount every year for the next 3 years. So because it's the same amount and it's coming in at the same time in the same intervals, we're considering this an annuity, so we need to consider the present value interest factor of an annuity in order to do that. All right, so first of all, the formula we want to figure out is the sales minus costs times 1 minus the tax rate. In this example, the tax rate for this organization is 35%. So first order of business, we take the sales of $2,650,000 minus $840,000 in costs times 1 minus 0.35. And that gives us 1,810,000 times 0.65, and that leaves us with $1,176,500 of each year for each of the 3 years. All right, and again, because it's the same amount every time, we're going to consider this an annuity. And a couple of other items that we're going to need to know, or variables rather, we're going to need to know in order to calculate this is N, the period or number of years. In this case, we're told it's 3 years, and also the required rate of return. In this example, the required rate of return is 12%. All right, now to enter this onto our calculator, our BA+, again, before you attempt any of these calculations at all, you want to press your CF button and make sure that this is set to 0. If not, you want to make sure you hit the second button and then the clear TVM button here to clear it, and then again second and hit clear work, right? Again, we want, and then you can double check it by hitting the CF button, and it should come up to 0. Now you're ready to go ahead and input your variables. You must make sure to do this every single time for each question to make sure you don't have anything residual left in your calculator, because even though you will get some sort of value when you finish your calculation, it won't be the correct one. All right, now the first entry that we're going to make will be the 1,765,500. So we'll put in the 1,176,500. Now, for this calculator's purpose, whether this is money going out in a regular interval, such as a payment, or we're receiving money coming in on a regular basis, the calculator is considering that a payment. So it could be a payment going out or a payment coming in. So after we key in the amount, we simply hit our payment key right here. And you should see payment equals 1,176,500. And then hit enter. Now we've only got 2 more variables we need to input. One is our required rate of return, which we know is 12%. Push the 1, 2, and our IY button here. And then select enter. And then the last variable is our N, and we know that the periods are 3 for 3 years. So we'll put in 3, and we'll hit our N key and enter. All right, so the last thing to do now is we just want to compute the present value of this. So we go here and we select our CPT or our compute key here, and we hit present value. And our present value of that annuity is $2,825,754.49. Okay, so I hope you found that helpful, and always, if you need to, rewind and go back and practice this until you get it and you know it cold. So again, what we were calculating there was a present value interest factor of an annuity. So we had a regular stream of funds coming in of 1,176,500. We had 3-year time period with a required rate of return of 12%, and the present value of that was $2,825,754.49. Again, I hope that helps, and we'll see you all in the next tutorial.